Welcome to Talk Techers, the deep dive into earnings calls that matter. We cut through the noise, examine the data, and deliver the insights so you know exactly what management is saying and maybe what the market might be missing.
Today, we're unpacking the Q2 fiscal 2026 results for Hooker Furnishings. They came out ahead of market open on September 11th. And the story here, well, it's kind of a dramatic race against time.
A race? How so?
Can their massive internal restructuring, all these self-help measures, actually offset the crushing external pressures, tariffs, the housing market softness?
Right. That's the central conflict, and it explains why the market reaction felt, well, pretty volatile. Let's maybe start with the hard data.
Yeah.
The second quarter was undeniably defined by some pretty significant misses relative to expectations. It just shows how punishing the home furnishings environment still is.
Absolutely. If you just looked at the core numbers, the initial sticker shock was brutal. Revenue clocked in at $82.1 million.
$32.1 million.
Oh, okay. Now, that was a major disappointment. It fell short of the consensus range, which was sitting roughly between $91.2 million and maybe $93.7 million.
Wow, so quite a miss.
Yeah, it equates to a sharp 13.6% decline year over year.
And I assume the bottom line reflected that steep drop-off.
Oh, definitely. They reported a GAAP EPS loss of $2.31. And for context, the street was braced for a loss, sure, but they only expected around $2.12.
So they missed even that low bar by quite a wide margin.
A very wide margin. And you see why when you look at the consolidated operating loss, it widened to $4.4 million.
Yeah.
Now, importantly, that did include about $2.1 million in total restructuring charges, which, management kind of uses necessary medicine right now.
Right, pay now to save later.
Exactly. So that initial data, the revenue drop, the deep loss, that's what drove the sharp sell-off initially.
Yeah.
But then the earnings call immediately shifted focus. You heard a management team completely fixated on controlling what they can control costs.
Okay, so that consolidated loss looks terrible on the surface, but we know the company operates in distinct segments. How do you reconcile that pain point with management's sort of confidence? Where's the silver lining buried in these segment numbers?
Well, the silver lining is definitely in the legacy business, but first, we really have to look at the primary cause of the pain. We saw a dramatic tale of three segments this quarter. It really highlighted this severe dichotomy within the business.
Let's start with the one really dragging things down then. Home Meridian, or HMI. That segment, which typically caters to more value-focused imported furniture, saw sales plummet. Is that fair to say?
Oh, plummet is the right word. Down a staggering 44.5% year over year. That's basically an implosion, not just a slowdown.
Wow, 44.5%. Why? What drove that?
Management detailed it pretty clearly. They broke it down into three main factors. First, there's the hangover from losing a major customer who filed for bankruptcy last year.
Ah, right. I remember that.
That alone accounted for about 25% of HMI's sales decrease. Second, they saw lower activity in their hospitality project shipments, which is, a project-based business, and the timing just wasn't great this quarter.
Okay, bankruptcy and project timing. What's the third piece?
And third, it's that widespread buying hesitancy among those value-focused customers. This is where the macro pressure really bites, forcing consumers to delay big purchases like furniture.
And we have to connect that hesitancy directly to that other big external headwind, right? The new U.S. tariff environment.
Exactly. Management confirmed the threat of the new 20% tariff rate on imports from Vietnam, which is set to be effective August 1st, 2025, is creating significant friction right now.
Yeah, that makes perfect sense. I mean, if you're a retailer trying to plan inventory 9-12 months out and you've got a potential 20% cost hike hanging over your head, you're going to hesitate. You might pause orders, especially in a really price-sensitive segment like HMI.
Exactly. When margins are already tight, a tariff like that is just poison. What's encouraging, though, is how the legacy segments of the business responded. They showed some real resilience amidst all this chaos.
Okay, so tell me about the bright spots.
Hooker Branded, the company's core nameplate, actually managed sales growth, 1.3% year over year, and importantly, achieved break-even operating results for the quarter.
Break even while absorbing restructuring costs.
Yeah, they absorbed over $650,000 in restructuring costs in that segment alone and still hit break even.
It's pretty solid. And the other legacy segment, domestic upholstery,
also showed tangible progress on the efficiency front. They significantly reduced their operating loss by 68%, actually, shrinking it down to just $0.4 million.
Okay, so that's real evidence that their localized efficiency gains, the internal stuff, are starting to flow through the P&L, the profit and loss statement, even before the full, $25 million in savings really kicks in across the board.
That segmentation is absolutely key. It demonstrates the savings are sticking in the areas where management has tighter control over the supply chain and production. And they are fighting that tariff threat with precision, too.
How so?
Well, Hooker Branded is using SKU level pricing evaluations, not just a blanket increase, right? And they're actively finding new sourcing partners outside of those high-risk regions. Meanwhile, Domestic Upholstery is laser-focused on mitigating the impact just on the component parts and fabrics they import.
So this brings us right back to the core management message, which, like you said, dominated the call, the absolute necessity of this restructuring.
Yeah.
Because of the pain in HMI, they're executing this deep, multi-phase restructuring, basically scaling the fixed cost base for this current challenging demand environment.
And the target is aggressive. I mean, it completely changes the profile of the company. They aim to eliminate roughly $25 million in annualized fixed costs.
$25 million annually. How much is that relative to where they were?
To put that in perspective, it equates to about a 25% reduction from their fiscal year 2025 fixed cost levels.
A 25% reduction in their fixed operating costs. That is massive. How are they breaking down that $25 million? Where are the cuts coming from?
It's split into two main buckets, and it shows where they're making some, frankly, painful cuts. About $11 million is coming out of warehousing and distribution costs.
Okay, logistics.
And a significant $14 million is being cut from SG&A, that's selling, general, and administrative expenses.
Right, the overhead. That $14 million is where you see the deep human capital cuts, probably fewer layers of management, reduced operational spending.
Exactly. That's the tough stuff.
What's fascinating here, though, is the timeline. Management was very specific. They stated they are on track to have this new lean expense structure largely in place by the end of the fiscal 2026 third quarter. Why is that timeline so crucial for you, the investor?
Because it means that the full $25 million annualized run rate savings will largely be realized starting in fiscal year 2027. This shift in the profitability timeline, getting leaner faster, is probably the single most important factor from this call. It provides a potentially massive buffer against that macroeconomic weakness.
And we see two very smart, very tangible operational moves supporting this speed and scope. Let's talk about the logistics pivot first.
Okay, yeah, this is, I'd almost call it a revolutionary operational change for an imported goods business like theirs. Their new Vietnam fulfillment warehouse. It's now live.
And the impact.
It drastically cuts container lead times. Think about this. From 6 months down to just 4 to 6 weeks.
Wait, hang on. 6 months down to like 1 month.
Pretty much.
That's like a 90% reduction in lead time. What does that even mean for their balance sheet, for their operations?
It's enormous. Think about it. A 6-month lead time forced Hooker to keep tons of expensive safety stocks sitting in U.S. warehouses. That ties up capital, exposes them to huge inventory risk if market demand suddenly shifts.
Right. If trends change, you're stuck with old stuff.
Exactly. By moving fulfillment closer to the source in Vietnam and cutting that lead time so dramatically, they drastically reduce the need for all that U.S. safety stock. It fundamentally shifts the inventory risk profile for the better. And as a side benefit, it allows their customers to mix different product collections more easily on orders, making ordering more efficient for them too.
That's actually brilliant. Okay, the second operational move is maybe less brilliant, more painful, but necessary to realize those savings. The Savannah warehouse closure.
Yes, the Savannah, Georgia warehouse is scheduled to close by October 31st, 2025. This exit coincides with an expected $2 million in additional restructuring charges hitting in the second half of FY26, mostly tied directly to that closure.
So more charges up front.
Right, which confirms the expense path is real. They're biting the bullet, taking the one-time hit now to ensure those long-term annualized savings flow through later.
Okay, let's connect this to the bigger picture, the capital structure. Despite these operational losses, the company actually repaid $16.5 million of debt year to date.
Yeah, which is notable.
And they reaffirmed the $1.23 per share quarterly dividend. What does that signal to you?
Well, it signals that management has confidence, or at least wants to project confidence, in their current liquidity and, more importantly, the future cash flow improvements they expect from this deep restructuring. They also mentioned they still have nearly $68 million in available borrowing capacity.
So that dividend reaffirmation, despite the loss, really speaks volumes about how seriously they view this $25 million cost reduction target. They seem to believe the path to free cash flow generation is clear even in this downturn.
I think that's the message, yes. They believe they can get there.
Therefore, the focus for investors, for you listening, it shifts entirely from Q2 results, which are, they're done, a sunk cost execution. Q3 and Q4 become critical.
Right. And the key tension remains. Will that $25 million in annualized savings flow through before sustained tariff pressure or maybe further hemorrhaging in the HMI segment just eats up all those potential gains?
Which raises an important question. Cost control alone isn't a long-term growth strategy, right? So what are the organic growth drivers management is banking on? How do they plan to actually use that newly slimmed down cost structure?
Good point. They are strategically investing in what they see as higher growth channels, things like hospitality, contract furniture, the outdoor category. But the biggest near-term catalyst, the one everyone's watching, is the October debut at the High Point Market.
High Point Market, which, for those unfamiliar, is basically the furniture industry's single most important trade show. It's where retailers place their major orders for the upcoming year, and the big debut is the Margaritaville licensed collection.
Yeah, Margaritaville. The CEO actually described this line as a massive 18-month strategic undertaking from a product development standpoint. It's not just, another product line they're rolling out.
Why is this licensing deal so strategically important right now, beyond just, another collection?
Because it's about brand diversification. It's about tapping into a potentially different customer demographic. Margaritaville is a widely recognized consumer brand, right? Not just a traditional furniture name.
Yeah, people know the name.
It attracts potentially a younger, maybe less rate-sensitive, more aspirational customer, kind of the exact opposite of the value-focused customer who seems to have abandoned the HMI segment. If this launch succeeds, it could really elevate the entire company's visibility and brand perception.
And are there any signs that things might be turning even slightly? Any green shoots, as they say?
Well, there were some subtle signs in the legacy segments, actually. Management noted that July orders were actually up 24% year over year in both the branded and domestic upholstery segments.
24% in July. That's interesting.
Yeah. And overall, for the entire quarter, Hooker branded orders were up nearly 11%, and the backlog rose 7% year over year for domestic upholstery. That momentum, kind of consistent across different regions, it hints that maybe the core retail market might be quietly stabilizing a bit.
Okay, so putting it all together, the immediate near-term checkpoints for investors watching this company seem very clear. First, that Q3 FY26 checkpoint, did they hit the run rate savings target?
Absolutely critical.
Second, the reception, and more importantly, the order flow following that Margaritaville launch in October at High Point. Does it land well?
Yep. Does it generate buzz in orders?
And finally, just keeping an eye on any clarity on broader macro conditions, especially things like housing turnover or any further tariff actions.
Exactly. Okay, so now let's move to the part of the show where we try to figure out if there's a way to monetize this complex story.
Right. Now, for the segment where we let our inner hedge fund analyst personas roam free and craft a wild, yet perhaps plausible, trade thesis. Based on this pretty complex call, we see a specific, maybe short-term volatility play emerging. What's the pitch?
Okay, analyst hat on. The consensus right now is absolutely fixated on the HMI implosion and that devastating headline loss. My thesis, though, is a short-term long position, and it's based almost entirely on the outcome of the October High Point Market. This is fundamentally a bet on extreme earnings leverage.
Explain that leverage. Why does the cost-cutting amplify the importance of just one product launch like Margaritaville?
Because the company has taken a hatchet, basically, to its fixed cost base, slashing it by 25%, that $25 million number. Since they've committed to this, and it seems like they're on track, every new dollar of incremental sales they achieve after Q3, after those costs are locked in, well, it's going to fall to the bottom line at a dramatically higher rate than it would have a year ago.
Right. The operating leverage kicks in hard.
Exactly. It's like, paying off your mortgage, suddenly every new dollar you earn yields far more pure profit because your base costs are so much lower.
So Margaritaville isn't really about rescuing the current quarter. It's about proving the viability, the power of that newly optimized cost structure going forward.
Precisely. Margaritaville is designed to be the catalyst that utilizes that leverage. It's this massive undertaking designed to grab market share in a new demographic. So if the launch generates significant excitement and, crucially, pre-orders, the kind that immediately build up that Q3 backlog, it could signal a really powerful inflection point much sooner than anyone expects.
Especially when you couple that with the Vietnam logistics hub cutting lead times by 90%.
Right, allowing them to actually fulfill those potential new orders rapidly and efficiently. It all ties together.
What's the actual trade, though?
The trade is, we go long into the High Point Market news flow in October. We're betting that the initial deep sell-off completely failed to properly value the potential earnings leverage coming from that new cost base, especially when combined with a potentially successful brand diversification like Margaritaville.
And the risk.
The risk is obvious. Demand stays flat, the macro picture worsens, or Margaritaville just flops. Maybe the brand doesn't translate to furniture orders.
Not the reward.
The reward is a potential rapid multiple re-rating if this new brand does lift the boat and proves that the internal self-help measures are actually stronger than the external macro headwinds right now.
Okay. So this deep dive into Hooker Furnishings Q2 results, it really reveals a company in the, let's say, painful middle stages of a major restructuring. They're taking necessary, aggressive, and sometimes quite painful steps to execute on everything they can control internally.
Yeah, the clear takeaway for you listening is that management is executing a plan. It's focused squarely on cost control and supply chain agility. They're trying to position the firm for profitability even without a big recovery in the housing market. They've basically built or are building an incredibly efficient engine.
Right.
The question remains, though, will that Margaritaville catalyst provide enough fuel to actually make that engine roar? Or will the continued external macroeconomic pressures, housing softness, new tariffs, consumer caution, force the company to just idle that efficient engine for longer?
That's the key question. Thank you for joining us for this deep dive.